This has been our highest revenue growth since the same quarter in 2021. Our services business grew 3.1% quarter-on-quarter in constant currency. Even in a seasonally weak quarter for services business, this is a remarkable performance. Our software revenue grew 5% year-on-year in constant currency, which is again a stellar performance. We delivered a stellar margin of 19.8% for this quarter, 126 basis points improvement sequentially, and 16 basis points improvement year-on-year. And this is after taking into account the wage hikes that we had in the last quarter, and also the impact of year-end holidays, because of which the billing gets impacted. I'm also happy to share that we've got the highest number of awards at the ISG Star of Excellence this quarter. Again, a very strong demonstration of our leadership across multiple IT service sub-services. Coming to our business segment, our software business delivered an outstanding performance by growing 5% year-on-year in constant currency. This is attributed to a significant improvement in our subscription and support revenue, which is what we've been strategizing and trying to grow. Our ARR, which is the annual recurring revenue, continues to grow and is at $1.06 billion, a growth of 2.9% year-on-year in constant currency. The software business also delivered very strong profitability with the EBIT of 32.9%. Double-clicking on our services business, our ERS segment led the pack, growing 8.7% quarter-on-quarter in constant currency. This growth includes our recent ASAP acquisition. Our IT and business services segment grew 4.3% on a year-on-year basis and 1.9% from a quarter-on-quarter perspective on a constant currency basis. Coming to verticals, our telecom and media business delivered a growth of 25.9% sequentially in constant currency, fueled by the timely execution and ramp-up of the mega deal that we had won last quarter. This was followed by manufacturing at 7.6% quarter-on-quarter in constant currency, with ASAP contributing to a healthy portion of our growth in manufacturing. Our financial services business declined 1.3% quarter-on-quarter, primarily due to higher furloughs in the last quarter, and it has grown 12.9% year-on-year in constant currency. This is a very strong performance from a year-on-year perspective for the financial services business. Retail CPG grew 2.9% on a QOQ basis, also delivered 11.7% growth on a year-on-year basis in constant currency. From a geographic perspective, Europe delivered 5% growth QOQ in constant currency. Of course, this includes the ASAP acquisition, while Americas came in at 3.1% QOQ, but all of that is organic growth, and 6.7% year-on-year in constant currency. Our rest of the world business declined 5.3% QOQ in constant currency, primarily due to higher furloughs and some ramp downs in some projects. Overall, we signed 18 large deals during the quarter, 6 for services and 12 for the software segment. Our net new bookings stood at $7.5 billion on a YTD basis, which is a 10% growth over the same period last year. Our pipeline continues to remain healthy and well distributed across large and medium-sized deals. On a LTM basis, we added $300 million clients and 4 $50 million clients on a year-on-year basis. Also, another very good achievement is our attrition on an LTM basis stands at an all-time low of 12.8%, which is a sequential decline of 1.4% and the lowest since the AMJ 21 quarter, which is the quarter in which COVID had hit. Our overall employee strength continues to grow. It's a 1.6% growth, and our total employee count stands at 224,756 people. Now, as I look ahead into the rest of the financial year, It continues to be an environment where opportunities and challenges coexist. Clients are having a few strategic priorities like modernizing data, modernizing SAP, cloud engineering, FinOps, and also the evolving IT operating model, apart from scaling GenAI for new business models. In parallel, enterprises are also prioritizing operational cost improvements as well as low-code capabilities that boost efficiency and improve client experience. While we see great potential in generative AI, in the near term, the programs in this segment will be small. We signed 31 deals in Gen AI, but most of them are sub-$1 million kind of ticket sizes. We are expecting them to ramp up in the coming quarters. While we still don't see an uptick in the discretionary spend, it remains pretty much similar to what it was in the last quarter. There is still a portion of tech spend that is looking resilient. Cloud migration, SAP core and data modernization, cybersecurity, automation, and advanced analytics are the areas where we think the spend is still robust. Coming to Q4, we expect a good growth in the services business, and we will see the seasonality impact in our software business. Given this FY24 guidance, we expect our overall revenue growth to be between 5 and 5.5%. We expect our operating margin to be between 18 and 19%. Looking further ahead, we remain very positive about our medium-term growth, enabled by our business mix, by our incredible people, and our laser-sharp focus on delivering innovation and hyper-automation to our clients. In summary, it's been a remarkable quarter with an all-round performance, be it growth across services or the software business, margins in our desired range, the highest margins over the last 2 years, strong growth in key geographies like North America, a good deal wins, healthy pipeline, and the lowest attrition in the last several quarters. The credit goes to the entire HCL Tech team, and I would like to thank all of them for the incredible work done over the year and last quarter specifically. Once again, I wish all of you a very happy new year, and I will hand it over to Pratik to provide more colors on the number.
Thank you, CVK. So, happy new year to every one of you, and as we go into the harvest season, you know, there are different festivals across the country in different states, so happy Lodi, happy Makar Sankranti coming up, and Bihu and Onam and Pongal and so many festivals. So festive greetings to all of you. Coming to the numbers, so CVK has given the numbers by and large, so I'll bring in the cricket analogy before anybody asks me to, or one of my friends in the analyst community just texted, it's a sixer of a quarter, right? I mean, you look at constant currency growth or US dollar growth or rupee growth, it is all a sixer sequential growth. It's also a sixer on the net profit or profit after tax, net income growth as well. So it's a sixer because of three main reasons, driven by outperformance in software business, 5% year-on-year growth, and fantastic growth in the US telecom vertical and in the ER&D segment. So just to put the numbers out there, in rupee terms, HCL Tech revenues stood at 28,446 crores, 28,500 to round it off, 6.5% growth in rupee terms. And our services business met a new milestone of $3 billion or 12 billion run rate, which is 1 lakh crores, by the way. So that's a significant milestone that our services business achieved this quarter. 25,082 crores was the exact number, which was up 6.4% year on year. Within that, ITBS was up 6.6% year-on-year, and ER&D was 5.6%. And of course, software was 6.8% in rupee terms, 5% in constant currency. Moving to the profitability metrics, EBITDA came in at 23.8%, and in rupee terms was a growth of, again, 6%, 6.2% year-on-year. EBIT margin came in at 19.8%, which was up 7.4% year-on-year in rupee terms, up 16 basis points year-on-year. And net income came in at 15.3%, which was again up 6.2% year-on-year, and flat in percentage terms year-on-year. I would also like you to note that we achieved the highest EBIT and highest net income in any quarter so far. In rupee terms, EBIT was at 5,615 crores for the quarter, and net income or profit after tax was 4,350 crores. So these are again milestones that we would hope to keep exceeding as we go forward, but as of now, this is the highest ever. The third profitability metric is the return on invested capital, which we publish as a separate page in our investor release, which you must have got used to by now. This has kept on improving quarter after quarter, and in this quarter, it stands at 32.8% at a company level, and our services business moved 40.1, so crossed the 40% milestone, and that is a increase of 300 basis points at a company level and 273 basis points on a services level. Cash generation continues to be very, very healthy. Operating cash flow came in at 22,200 crores, and free cash flow at 21,100 crores for the last 12 months up to December, which is calendar year basically. And that is 142% of the net income in terms of OCF, and free cash flow at 135% of net income. Balance sheet remains strong, getting stronger every quarter. $2,900 million gross cash, $2.9 billion, and net cash at $2.62 billion. From a shareholder perspective, the earnings per share last 12 months diluted EPS is at 57.87% rupees per share, which is an increase of 8.5% year-on-year on a last 12-month basis. The board has declared a dividend of 12 rupees for the quarter, like similar to the last quarter when we increased from 10 rupees per share per quarter to 12 rupees per share per quarter. So that same 12 rupees has been maintained. The record date for which is 20th of January, and the payment date will be 31st of January. That takes the payout ratio, the dividend ratio, at 90% for the last 12 months, a little higher than our payout run rate of about 88% that we've maintained for the last 2 years, in the same ballpark. With that, I'll hand over to Ram for the HR update.
Thank you, Prateek. Good evening, and I'll also join my colleagues in wishing everybody a very happy New Year, and also a happy festive season across the country in this country. I think all the financials you've heard, the positive story on financials, it's all credit to all our employees. 224,756 of them contributed to that. That headcount is a net addition this quarter compared to what it was last quarter. It's a 3,617 net increase in the headcount this quarter. We continue to honor the commitments for fresher onboarding. So this quarter we onboarded 3,818 freshers. That's tracking to the plan that we have for the year. Attrition, again, CVK called out, it's the lowest in the last 7 years, 12.8%. Compared to this time last year, it's a 9% drop. So that's a positive story. And this quarter, we also implemented the pay increases that we said we're going to roll out for our employees in the entry to junior level. So that has also been implemented this quarter. So all in all, it's a positive quarter. I'll just pause there for any other questions. We'll open the floor for questions.
Hi, I'm Annapurna Roy from the Economic Times. First of all, just to check, with the fresher additions in this quarter, does it take the total number of freshers onboarded in this fiscal to around 7,000? Is that it?
This fiscal, it'll be about 9,000.
9,000, okay.
Yeah.
And regarding the Verizon deal, does the growth in that vertical come entirely from that deal, or how does the vertical perform if you exclude that? And also, after the exit of V.V. Appa Rao, who is going to be leading the Vistas program? And how do you see the margin impact of, first of all, the hikes, and secondly, the ASAP acquisition and the Verizon deal? You can elaborate on that. And the decision to skip senior level increments, was that, did you think that had an impact on senior level attrition as well? And lastly, could you also elaborate a bit on why there was a dip in the BFSI?
I will take a couple of questions, then I'll request Prateek and Ram to address the rest. First of all, Verizon deal, of course, contributed significantly to the vertical growth. But we don't call out how much each client has contributed, so that's something which we don't share externally. Then after Appa Rao's leaving, all the nearshore responsibilities are with the Chief Operating Officer, who is Rahul Singh. He handles all the corporate functions, so all the nearshore responsibilities with Rahul Singh. And there was a question on attrition and there was a question on margins, if you can answer. And then on the BFSI, let me answer and before I hand over. BFSI has shown a very strong growth on a year-on-year perspective. And this quarter, usually towards the end of the quarter, it's a holiday period and there is some mandatory time offs, which different clients mandate. So which means it impacts the revenue. So it's only, that's the main reason. Outside that, it's done well.
On the margin side, you had the question about the increments impact. That was about 65 basis points, right?
Acquisition and Verizon. Margin impact of ASAP acquisition and Verizon.
Okay, so again, like CVK already mentioned, like we don't mention the revenue contribution, we don't mention the margin, this thing for individual clients or acquisitions, but ASAP in any case is a company which we will be publishing the subsidiary accounts at the end of the year, so it's nothing to be hidden there. It is low single digits kind of a margin, at least in the beginning, and as we progress, it will it'll mid single digits kind of margin. So, so the overall 19.8 is obviously including all of that.
You had a question on attrition. I'm just trying to refresh my memory. Okay. I think we have to look at it in the context of who all were covered in the pay increases. Even though we said that we took a call to skip increase for senior management team, the pay increases covered 90% of our employee base. So what is not covered is not a large proportion. And there's been no impact because of the decision on attrition. And our leadership team is very stable. There's been no impact.
Siddharth, can we take the online questions, please?
Thank you, Ashutosh. Ladies and gentlemen, in case you are on a computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel and we will unmute your line. Our first question today is from Surbhi Agarwal from ET. Surbhi, we have unmuted your line. Please go ahead.
Understand, what are your thoughts on the macro environment in terms of the tech spending? So could you provide some clarity on what kind of deals are we seeing in the market? What are the kind of conversations that clients are having? Some of your peers yesterday said that the demand environment continues to be significantly stretched and there's been no change or uptick in the sentiment. So do you sort of agree with those views, or are you seeing some green shoots?
Yeah, I would respond to that in two parts. I mean, one is, of course, the macro environment, and a broad message will be we didn't see a change in the last quarter. But if I have to kind of drill down a little bit, if you look at our ER&D business, where there is more engineering outsourcing, new product development kind of work. I mean, last 2 quarters we've been growing, and it does look like we will continue to grow. So I think on that front, we feel a lot more positive about the environment and the spending, and some of that is coming from the tech vertical. But if you look at the broader IT spend, I think discretionary spending has really not picked up. It remains at similar levels like what we saw in the previous quarter. But however, having said that, there are always some bright spots where the spend is resilient, like cybersecurity is an area, SAP migration is an area, data. Now, a lot of customers are embarking on GenAI programs, but it also means they need to significantly transform and evolve their data landscapes. So that is again a big opportunity area, and we see some opportunities in that space. So while the overall discretionary spend environment would be similar, there are some pockets where we believe there is strength, and we are focusing on that. And then the biggest opportunity continues to be hyper-automation, delivering hyper-automation, efficiency, productivity benefits to clients. And that's a big theme which is continuing to play out in vendor consolidation and cost takeout opportunities. So this is how I would kind of describe the demand environment.
And if I could ask a follow-up question, CVK, earlier past few quarters, everybody, including HCL, has been saying that how there's a lot of deal bookings, but they're not converting into actual revenues because clients are cautious and there's an uncertain environment. So how do you interpret the Fed statement? Because that certainly, kind of changed the sentiment a little bit. Has that translated into some of those paused conversations restarting? Are you seeing that happening in some pockets? Could you just give us some sense of how 24 will pan out for you and probably the rest of the industry?
Sure. So, I mean, on the revenue, I mean, the order booking and translation to revenue, I don't want to comment on others, but if you look at our bookings and revenue, there is a very strong correlation. Like last quarter, we had a historically high booking, close to $4 billion. We see it translate to revenue this quarter. So I think we've done our internal analysis, and the way we classify booking, it's all net new booking, and that has a very high correlation to the revenue. So that's one. Now, sorry, what was the second part of the question?
Has there been any change post the Fed statement on interest, US Fed statement on
I would think it's too early. We haven't seen any change, which is, I mean, that from such a high macro indicators translating into change in maybe a sentiment is not going to happen overnight. I think it's going to take a couple of quarters at least. So we haven't seen any change in sentiment from a spending perspective.
From me, how has the BFSI and America's market been for you? What are the signs?
Yeah, we are positioned as a disruptive service provider in the BFSI space, and of course this quarter was impacted by furloughs. I do believe our prospects in BFSI continues to be strong. We've grown 12.9% year on year. That's the highest probably anybody's BFSI business is growing. I think it's again led by efficiency, hyper-automation, and some specific programs around data and cybersecurity, and those are the opportunities in financial services that we are looking at.
Sorry, if I could just squeeze in one last question, CVK, for you. Is it becoming difficult to retain senior talent? Because right now we are seeing a never seen before unprecedented sort of churn when it comes to senior ranks in the companies, especially at a time when you've not even given them hikes and things are sort of been tough and uncertain for the industry. How hard is it to sort of keep senior talent from being poached?
We've had a very stable leadership team for a long time, and that continues. Maybe Ram, you can elaborate anything more.
What we define as senior leadership team, if we look at our retention of senior talent, it's pretty impressive. The attrition amongst the senior leadership is a very low single digit, very, very low single digit, negligible, not noticeable. So pretty healthy.
And we attribute it to the kind of entrepreneurship culture that we have within the company. I think every leader feels quite empowered to do the right things for the business and grow. And that's a culture which is ingrained in our DNA, and I think it really helps. Everybody thinks of it as it's their own business, and they chart a course of action and execute remarkably well.
And people like me go out and come back again.
Siddharth, next question, please. Next media, please. Yeah.
No more questions.
Thank you, Surbhi. The next question is from the line of Shovik Das from Mint. Shovik, please go ahead. Shovik, we have unmuted your line. Please go ahead.
Hi, can you hear me?
Yes.
Yes, we can, please.
Okay. Thanks for that. CVK, and probably this is a general question for whoever would want to take. Couple of things. First, if you could offer some sort of color on the kind of demand that you're seeing for generative AI. We've been hearing through the entirety of the past calendar year that there are pilots and the pilots are increasing. But are we getting closer to seeing any substantial revenue coming from generative AI across various sectors? That's one. And the second is regarding a pretty sharp growth in EBIT margin in HCL Software, where I think this quarter HCL Software reported a 33% EBIT margin increase. Could you sort of give some color on what contributed to that as well?
You want to take GenAI demand?
Oh, so GenAI, it's right that we are seeing a lot of programs. Most of them are pilots which are being implemented. We are seeing some very good success out of the pilots that we have implemented. In fact, this quarter we had, as I mentioned, 30 plus GenAI specific orders that we won, which are all under execution. While the real scale-up will happen over a period of time, but more than GenAI, the need to kind of adopt GenAI in a very effective manner is driving significant spend in the data landscape, both data modernization, cloud migration. Some customers are trying a private stack for their own LLMs. So it's the surround spend which enables GenAI. That's where the biggest opportunity is. And as a kind of holistic service provider with hyperscaler partnerships, hybrid cloud, private cloud capabilities, and strong presence in data, all of that, we think in the next 2-3 quarters we will see some sizable programs, which is kind of driven by the aspiration of what GenAI can do for an enterprise, but it's really getting all the foundational blocks in place. So I think it'll take a couple of more quarters in our assessment for this holistic programs to come to life. And Pratik can answer the software question.
Yeah, Shovik, to your second question about the software EBIT, that is a seasonality that was there in December quarter last year. It was 32.6% or something like that, and this quarter it is 32.9%. Basically what happens is we are in touch with more customers in the December quarter because of the renewals coming up for their annual contracts, etc. So that gives us the opportunity to be able to sell them more software licenses, and that is what a large portion of that really flows down to the EBIT line, because we don't obviously spend that much higher on the cost side. So that's really the seasonality in software.
Thank you, Shovik. The next question is from the line of Ronendra from HBL. Ronendra, please go ahead. Ronendra, we have unmuted your line. Please go ahead.
Am I audible?
Yes, Ronendra.
Hi. Just wanted to get a picture on what CVK had said, that there are opportunities and challenges, both this. So can you elaborate a bit on what kind of challenges are you facing, and in the US market, especially being the election year this year, do you see any impact or challenges coming in the coming quarters?
Yeah, the challenges are the discretionary spend is still muted. So I think that's definitely the concern, and some of the macro aspects and geopolitical aspects are continuing to put strain on our clients' P&L. So they are going to continue to look at every spend with a stronger ROI kind of an outlook. I mean, that's primarily the challenge. Opportunities, of course, there are a lot of bright spots, as I said, cybersecurity, SAP, modernization, data, and getting your landscape ready to get the full benefit of Gen AI. I think there's going to be a lot of foundational investments that are being made. So I think those are the opportunities at this point.
And Pratik, can you tell me what was the average salary hike, wage hike in the last quarter?
Sure. I think the percentage increases has been consistent with what we have done in the previous years. The percentages will vary by country. As I said, we've covered 90% of our employee base. So the percentages will vary by country. And the average percentage this year, what has been done is in line with what we have done in the previous years. Overall average will be about 5 to 7% depending on which country it is. The important thing is what happens to the top performers. So that continues to be in the 12 to 15% range.
Thank you, Ronendra. Our next question is from Shivani Shinde from Business Standard. Shivani, please go ahead. Shivani, we have unmuted your line. Please go ahead.
Can you hear me?
Yes, Shivani.
Right, hi. Good evening, gentlemen. Congratulations on a great set of numbers. I just have one question. CVK, if I have to look at telecommunications, this growth is primarily driven by Verizon, or when you remove Verizon, what kind of demand do you see in the telecommunications space?
Yeah, I mean, as I mentioned, Shivani, we don't call out client-specific numbers. We don't share that externally. But we continue to see demand for in the telecom segment is more around hyper automation and efficiency and cost takeout. That seems to be the biggest theme of demand in the telecom sector.
Right. Thank you so much.
Thank you, Shivani. Our next question is from Debangna from Money Control. Debangna, please go ahead.
Hi, CV. Am I audible?
Yes, Debangna.
Yeah. Hi, CVK. So I just had a couple of questions. Firstly, I wanted to understand what's your outlook on mega deals for 2024. Are there conversations happening? And the second part of it is there a delay in terms of, are you experiencing any delay in terms of deal closure timelines, or has it started to come down?
Yeah, I mean, Outlook for mega deals, I mean, at this point, we have a strong pipeline, and it's got a mix of small, mid-sized, and large deals. So we expect some of the deals to get converted in the Q4 and even next year. So pipeline is strong with different flavor of deals across the spectrum. At this point, we don't, I mean, most of the efficiency-led opportunities, we don't see any delays. However, if there is a transformation project which the customer had envisaged to kickstart it or to kind of get going, there has been some delays. So cost takeout deals, I think it's been pretty brisk. I mean, customers do want to realize the efficiency benefits at the earliest. So that puts a little bit of time pressure on everybody.
Right. Just one more follow-up. So you have cut your revenue growth guidance on the upper end by 0.5%. So what's driving that?
It's again basically we've looked at the performance this quarter. We look at what is possible in the next quarter. There's a seasonally weak quarter for the software business. Services business will still continue to grow. We'd given a 5 to 6% kind of a range. Given only one quarter, we had to kind of narrow the range. So we've done it 5 to 5.5%.
Thank you, Devangna. Our next question is from Vivek Kumar from The Informist. Vivek, please go ahead.
I wanted to ask that considering the large deals that you have in the bag today and the pipeline that you mentioned has been strong, so do you expect growth in 2024 to be, better than 2023? And has there been impact of furloughs in the early part of Jan-March as well, if you could specify on that? And on the margins front, you have your margins this quarter have come in at 19.8%, and you have earlier spoken about margin ambition of 19 to 20%. So is there a scope for increase in next quarter and upcoming year, given that it's a seasonally weak quarter for software business?
Yeah. So outlook for 24 at this point, we are guiding for financial year 24, which ends in March, where we expect to do a revenue growth of 5 to 5.5%. We're not giving any color on the next year at this point. I would wait for it. We will do that in April. In terms of the EBIT margins on software business. Yeah, so January is, generally the furloughs are higher in the December quarter, but we do have some furloughs in January as well, especially in the Asia Pac market. There are clients who come back from the summer vacations a little late. So that's again a possibility that January also there are some furloughs.
On the margins, the 19 to 20% that we have mentioned is a medium-term aspiration. Like we said, the guidance continues to be 18 to 19% for us for this fiscal year. And 19.8% is obviously a great number to have, but that's one quarter out of four. And our number for the full year would be in that range, 18 to 19. It's a seasonally good quarter. Even last year was 19.6 in the December quarter. So unfortunately, that's not true for the rest of the three quarters.
Thank you, Vivek. Next question is from Tasmia Ansari from Analytics India. Tasmia, please go ahead. Tasmia, we have unmuted your line. Please go ahead. Seems there is some technical issue. We have another question from PTI from Prasun Srivastava. He has shared the questions in the chat box. I'll just read out. What is driving uptick in telecom business for HCL? Which are the geographies that are driving it? The next question. What kind of capacity building HCL Tech is doing to meet AI-led demand? Will company need to go external hiring? Third question. One of your peers have announced foray in semiconductor engineering and design space. HCL Tech too was engaged with HCL Group for a semiconductor foray. Could you please provide an update on the same? And the last question, how is HCL Tech seeing the impact of inflation in US and Europe? What are the positive takeaway from there for the company? And if HCL Tech is seeing any impact of inflation in US and Europe? And what is the nature of AI deals that company has won and that are in pipeline?
Wow, that's a lot of questions. So, telecom vertical, of course, the growth is led by the large deal and it's led by the Americas geography. And AI demand is across many, many use cases. It's a lot of in healthcare, financial services, in CPG, different verticals. We have a number of projects. We have a section in our IR release which talks about all the Gen AI opportunities that we won. That should give you a good sense. In terms of the meeting the AI demand, we've trained close to 42,000 people internally across different areas pertaining to Gen AI. And we will continue to train extensively internally. And we are also continuously hiring some high-end talent in these areas from number of areas, from industry, academic institutions, and some of the ecosystem partners and things like that. Semiconductor design is, again, it's one of our service areas as a part of our engineering and R&D services. We do have a strong capability. We work with a large number of semiconductor clients for servicing their design, test, validation, verification kind of work. I would not want to comment on the speculations in the market and what HCL Group is doing. Right now we are focused on HCL Tech. Coming to the impact of inflation in US and Europe, of course it does put strain. Most important thing is it puts strain on our clients' P&L, especially a lot of retailers and things like that. There is already a cost inflation, and there is a limit to which they can increase their prices as well. So eventually it's going to impact their bottom line, and once it impacts bottom line, they're going to kind of tighten their spending patterns. So I think inflation will continue to have an impact on clients' discretionary spending areas. That's it. I think these were the questions that you asked.
I think we can. Yeah. Anything
Yes.
left?
Yeah. Thank you. Thank you, everyone. Over to you, Ashutosh.
Yeah, I think with this we come to the end of the press conference.
Yes. Thank you, everyone. Have a good evening.
Thank you.
Thank you.
Happy New Year.
Yeah.